Welcome to This Explainer. Today we are going to do a deep dive, really peel back the onion on KB Home's 2026 financial performance. Look, if you've been following the housing market lately, you know it is wild out there. We've got shifting interest rates, major affordability questions, the whole shebang. But today, whether you're a seasoned investor or just kind of curious about where housing is headed, we're going to tune out that macro level noise. We really want to get into the weeds on the deliberate, internal strategy that's actually driving KB Home's latest numbers. Right off the bat, we got to talk about this massive 27% year-over-year drop in Q2 revenues. I mean, on paper, a drop like that looks like a glaring red flag, right? It's the kind of number that immediately grabs headlines and sends investors running for the hills. But in business, context is literally everything. Hold on a second, though, because CEO Robert McGibney noted on their recent earnings call that they're navigating a pretty difficult and fluid market. They are carefully balancing pace and price while keeping a tight lid on costs. And what we're going to uncover today is that the sting of these lower numbers, it's actually a planned part of their strategy. There's a very deliberate operational reset happening behind the scenes, and it's causing this short-term pain entirely by design. So, here is our roadmap for this explainer. We're going to cover 1. The Q2 2026 financial reality, 2. The built-to-order shift, 3. Operations, build times and costs, 4. Capital allocation and returns, and finally, 5. Market valuation and outlook. Let's jump right in. Section 1. The Q2 2026 financial reality. Let's take a look at the surface-level numbers for the second quarter ending May 31, 2026. When you look at these metrics, it's a bit of a bloodbath on the surface. We're talking revenue down 27%, deliveries dropping 23%, and gross profit margins taking a 410 basis point hit. That's a 4.1% drop. But here is the crazy part. Despite all of this, the company actually met or even exceeded the midpoint of their own key guidance ranges. Management knew this trough was coming. They expected it. Why? Because they intentionally slammed the brakes on feeding the machine with speculative inventory. Which brings us to Section 2. The built-to-order shift. So, why are the numbers down so sharply, and what's the actual game plan here? The entire strategy hinges on a purposeful reset back to a built-to-order, or BTO business model. It's exactly what it sounds like. Instead of throwing up a house and just crossing their fingers that someone buys it, KB Home is waiting to sell the house before they even pour the foundation. This lets the buyer customize their lot and floor plan, but more importantly for the business, it builds up a massive, highly visible sold backlog. Think about the fundamental trade-off between these two models. The speculative model? Sure, it completely pumps up your short-term delivery numbers because the houses are basically ready to go, but it eats up massive amounts of cash and leaves you wide open to pricing swings. The BTO model, on the other hand, is a different beast. It actually generates an extra 300 to 500 basis points in margin. That's 3 to 5% of pure upside. It's way more predictable and incredibly capital efficient, even if it means sacrificing those flashy, immediate delivery volumes while that backlog is building up. And man, the momentum of this strategic pivot is absolutely staggering. Just look at this mix. BTO homes now represent a whopping 73% of their net orders in the second quarter. They've completely flipped their sales mix, which means right now they are heavily selling homes that won't actually be delivered and won't be recognized as revenue until the second half of the year. Let's move to Section 3. Operations, build times, and costs. Strategy is great on a whiteboard, but how are they actually weathering this transition out on the job site? Well, operationally, they are absolutely crushing it. When you shift to build-to-order, build time becomes everything. Faster builds mean you convert a sale to cash faster. KB Home successfully slashed their build times from 120 days late last year down to 108 days in Q1, and they managed to shave off more than a full week sequentially in Q2. That kind of operational success gives them a huge advantage in turning that BTO backlog into actual bankable revenue within this calendar year. Now, with all the affordability issues out there, you might be wondering if their buyer pool is degrading. Not at all. The underlying customer base remains incredibly rock solid. Through their joint venture, KDHS Home Loans, they're seeing an average FICO score of 743 and an average household income of $133,000. Plus, these buyers are putting down a super healthy 16%. That's over $72,000 in cold, hard cash upfront. So yeah, they are clearly attracting high-quality, highly committed buyers who are in it for the long haul. Up next, Section 4, Capital Allocation and Returns. Let's see how KB Home is handling its checkbook and returning value to shareholders during this transitional period. Even with that ugly revenue dip we saw at the beginning of this explainer, KB Home's balance sheet is basically a fortress right now. They're sitting on $1.12 billion in total liquidity. And they clearly believe in their long-term strategy because they confidently bought back $75 million of their own stock just in this quarter alone. That brings their total share repurchases for the first half of the year to a cool $125 million bucks. This ruthless discipline with their capital, funding growth while buying up shares, is really paying off. It has fundamentally improved the underlying value of the company, driving their book value per share up 6% year over year to $61.93. Finally, let's wrap things up with Section 5, Market Valuation and Outlook. How is Wall Street actually digesting all of this? Remember that massive backlog we kept talking about? Well, management's outlook shows exactly why they built it. They are projecting a major ramp-up in delivery volumes and a real bounce back in gross margins, jumping right back into that 16% range for the second half of the year. This is the exact turning point where that 73% built-to-order mix flips from a promise on paper into tangible reported revenue. Which sets up a really fascinating situation for us. We've got short-term revenues looking weak, but the stock price has actually been gaining some serious momentum. So we have to ask the million-dollar question. Is KB Home currently overvalued, or is it secretly undervalued by the market? If we pull some data from Simply Wallstead, we get two totally different, yet completely valid perspectives. On one hand, the fair value model, which heavily weighs those current slimmer margins and near-term revenue dips, suggests the stock is fully priced, maybe about 1% overvalued. But then look at the PE multiple model, which measures price against earnings. KB Home is trading at a 14.2x multiple. The fair ratio for the industry, almost 19x. That implies the company is actually trading at a pretty healthy discount compared to its peers. The market is literally caught in a tug of war between these two realities. And so I want to leave you with this final thought. KB Home is willingly taking a hit on short-term speculative volume to lock in long-term margin predictability and cash efficiency. What do you think will be the ultimate verdict on this strategic reset? Is the market going to punish them for the short-term dip, or are they laying the groundwork for a much stronger, premium business? Thanks so much for joining me on this explainer, and we will see you next time.